Monetary policies are no longer too accommodative for the fixed income market. All the rate hikes try to cool down what we can no longer describe as transitory inflation. But they have also dragged the returns of US investment-grade corporate bonds down by 11% so far this year. Interest payments are now just offsetting principal loss, and it may get worse. That's why picking the right corporate bonds, those with resilient earnings and low bankruptcies, is top of mind at the moment. In our latest white paper, we demonstrate how the risk-adjusted performance of systematic credit investing strategies can be significantly enhanced by incorporating real-time analytics from RavenPack Edge news and earnings call transcripts. We leverage some of the signals that we have used in previous research applied to equity markets, like the transcript signal, with its three components of event sentiment, document sentiment, and transparency, as well as the earnings intelligence signal, which incorporates earnings-related news published by the company. We have limited our selection to liquid, dollar-denominated, senior, unsecured, and investment-grade rated corporate bonds listed, cleared, and traded in the US public market, with bond issuers located in the jurisdiction of the United States, with a few more exclusions. We built a long-only credit benchmark weighted by market values. Then we assess the extent to which short-lived sentiment from individual companies enhances the performance of credit investing strategies, evaluating in particular the trade-off between performance enhancement and portfolio turnover. So what did we find? When we adjust the performance by unit of risk and in excess of the benchmark, we observe a higher performance enhancement for earnings news on the short term compared to transcripts. Benchmark adjusted information ratios increased from 0.32 to 0.68 for an effective holding period decreasing from 10 days to 2 days. When evaluating transcripts, the risk-adjusted performance enhancement is stronger than for earnings news on longer horizons. When evaluated individually and on a risk and benchmark adjusted basis, both earnings news and transcripts still demonstrate attractive and complementary performance depending on the time horizons. Interestingly, the earnings intelligence combination always outperforms the individual signals, steadily generating benchmark adjusted information ratios of nearly 0.60 at the 3-month effective holding period, compared to 0.40 for earnings news. This stronger performance enhancement comes from the transcripts component, as adjusted information ratios increases significantly from 0.25 to 0.50 for holding periods from 2 weeks to 3 months. We also found some really interesting results on earnings intelligence when your goal is to trim the number of active bets. As usual, we control for backtesting bias, and statistical significance tests confirm that sentiment-tilted portfolios meaningfully perform better than chance and outperform those with random tilts meant to describe zero-skill strategies. These results indicate that the information contained in news and transcripts adds considerable value in the signal construction process. Download our white paper for a complete description of our model and all results from our analysis.